Look, if Bitcoin at 100,000, it's still early days. I keep in mind the following: 95% of all the Bitcoin has been mined. There's only 5% left in the supply. That's very scarce. Like gold is still unlimited in its supply. Yet the US government wants to buy 5%. Institutions this year bought more than 5% of Bitcoin, and they probably want to buy 15%. MicroStrategy wants to buy 5% of Bitcoin. Another sovereign government probably will buy 5%. If you total this up, there's 40% non-retail demand for Bitcoin in the next 2 years for 5% that's available to purchase. That's why I think Bitcoin probably will have the same network value as gold, which would put it at around 1 to 1.5 million per Bitcoin.
The market turmoil was triggered by a perfect storm of events. It began with the sharp collapse of the S&P 500 from a recent high of 6147, a drop that was further intensified by the announcement of drug tariffs in February. This was quickly followed by the DeepSeek event, a sudden and unexpected disruption that added to investor anxiety. The final blow came on what became known as Tariff Liberation Day, marked by a dramatic escalation in trade tensions. Together, these catalysts led to a swift and severe 20% decline in equities over just 2 weeks. While the sell-off sent shockwaves through the markets, strategist Lee advised against panic. Drawing on historical patterns, he noted that 17 of the past 18 waterfall declines, rapid, fear-driven sell-offs, had ultimately led to strong V-shaped recoveries. This time was no different, as the markets quickly rebounded in line with the historical trend. And before that, be the one who says, "I was here before 100K. I'm on a mission to hit 100,000 subs before 2025 ends. Help me get there." Subscribe now and drop your thoughts on the market in the comments. Let's grow and win together.
April 2nd was a Black Swan event. And it's not the Black Swan movie premiere, but it was an improbable event, as Nassim Taleb talked about. And a Black Swan means something that is not expected to happen, but it has happened. And we know it was a Black Swan event because Nassim Taleb's Universa fund generated 100% return that month. His fund only makes money on Black Swan events, and the last time it made money was COVID. So this was indeed a Black Swan event. And because of that, the S&P went from 6,147 and collapsed because we had the drug tariffs in February, and then we had the DeepSeek event, and of course, Tariff Liberation Day. That triggered a huge amount of panic. And as you can see, we felt 20% in like 2 weeks. But instead of the market crashing, we had advised our clients that waterfall declines, 17 out of the last 18 waterfall declines were V-shaped. A waterfall decline in the stock market is not new information to you, it's a panic. When markets panic, just keep this in mind, it's usually a V-shaped bounce. And we argued it would be V-shaped, and in fact it has been V-shaped, contrary to what most people have said. Now, this is where I'd like you guys to make a personal assessment, because you aren't alone. A lot of people, when the market was falling, hedge funds, long-only managers, they went to cash. I've done so many Zooms in the past 2 weeks about fund managers that have probably 50% of the exposure they want to cyclical stocks, or even 0%. So they are panicked and they're hoping for a pullback so that they can re-risk. So here's 5 reasons why I think investors are still off sides, and that's why you've noticed that the stock market kind of has a bid every day, because people are still off sides. So let me explain. The first is, a lot of people said there was going to be a recession. And in fact, JP Morgan was one of the first. They said they raised the odds of a recession to 60%. But here's the thing. If you want to know who's the best at predicting a recession, I would say the single best economist is the high yield market. And this is the high yield market. And as you can see, it did soar. This is the spread to treasuries, to 460 basis points wide. But that's not a recession panic. The high yield market is not manipulated by the Fed or the Treasury, so it's pure signal. If you go back the last 15 years, 460 basis points wide on high yield is nothing, because during COVID it got to 1,000. That's a recession level. During the Fed's fastest rate cycle in history, it got to 600. That's not a recession signal. At that time, if many of you were our clients, we told you that's not a recession signal. It has to get to 800 or 1,000. And we were just at 460. So the high yield market said there's no recession. And then, as you know, recently JP Morgan basically dropped their recession call. So economists have predicted like 18 of the last 2 recessions. The supply chain is taking a hit. And then a lot of people are saying they're shorting stocks because of that, okay? And you might think that. You're going to say, Tom, the container ships from China, it's down 50%. So they're going to say, okay, it goes from the container ships to the trucking, to the warehouses, to the retail stores, and pretty soon everything's going to crash. But that's not how it's going to work. First of all, as you can see, as soon as the tariff wars de-escalated, container ship bookings jumped 50%. So it now looks like this. The stock market looks through that. That happens with government shutdowns. It doesn't really cripple the economy. Yet hedge funds were shorting cyclicals this entire time. So again, your people are looking at yesterday's newspaper and trading on it. The third is the VIX surged, but when the VIX surges, it forces everybody to liquidate. Okay, so the top chart here is the VIX, and the bottom is speculative longs on futures. Every time the VIX spikes, funds are forced to de-risk. Okay, but look what happens after the VIX goes down. They're forced to add risk. So here's the thing. In the midst of the VIX 60, our FSI clients got this message. You buy stocks when the VIX is over 50, and it's confirmed when the VIX is less than 30. Just remember that. The next time the VIX explodes to 60, it's a gift because you know everyone's being forced to sell. And the bottom in the stock market, we highlighted this, there's not been a single bottom that wasn't confirmed once the VIX falls below 30. So if you look back, that VIX 30 was like mid-April. The fourth is, many people say the U.S. is the end of U.S. exceptionalism, like they want to buy Europe. I just had a call with this client. He's so bullish on Germany, and I pointed out to him that German tech stocks are now 50% more expensive than U.S. tech stocks. Europe is not cheap, and they don't have great companies. In fact, if you look at the 25 biggest companies in the world, it's kind of hard to see the ticker. Only 4 of them are not American. I don't see how tariffs, a Fed being slow, people not liking Trump, I don't think how that's going to create 24 great non-US companies. All the best companies are in America. And then retail bought the dip. So if you are one of the few who bought the dip in April, congratulations, because you called it right and you nailed it. And we know retail buying was record during the sell-off. And I can't tell you how many institutions told us that they were shorting that because they want to short retail. They're dead wrong. Retail investors got this right. And yet, now what's happening? Hedge funds are frantically covering their shorts. It's going to take them a long time to cover their shorts. Okay, so now I want to look at 2026. So it's explaining where things are, and I will say, so if you are bearish still, I would urge you to think about 2026, okay? I think stocks are in better shape today than they were in February of this year. So when the market was at its old highs, I think it's actually a better risk reward now. First, we have visibility on the tariffs. So the tariff, if you didn't know what was going to happen in February, now you know what's going on with the tariffs. The second is you have to start looking at 2026. We're in the middle of 2025. The stock market always looks 6 to 12 months ahead. So you want to think about 2026 right now. And next year, we have tax cuts. We have a lot of deregulation in the pipeline. And we have more Fed cuts in 2026. Like the Fed's not cutting now, but they're going to cut next year. And companies are benefiting from freer trade. These tariff deals are allowing U.S. companies to have better access to other markets. That's big upside. So if you ask me, I think there's a lot of earnings upside for next year.
Tom Lee doesn't stop at analyzing equities. He also presents a compelling case for why Bitcoin is on the verge of a significant breakout. Backed by on-chain data, historical halving cycles, and increasing institutional interest, Lee argues that the current macro environment favors digital assets. With tightening supply, growing adoption, and Bitcoin's role as a hedge against monetary instability, he sees strong upside potential in the months ahead.
We've recommended a 2% allocation to Bitcoin at a minimum, but we've recently been advising closer to 5%. And if you're younger, 10% I think would be fine. And Bitcoin has 3 or 4 things it really follows, okay? It follows network effects. So the number of wallets and the activity per wallet still explains 87% of the price change in Bitcoin. Bitcoin still follows global liquidity, which I am shocked at, but there's a 10-week lead time. So if central banks ease, Bitcoin follows by 10 weeks. And the third is the halving, which is when the block reward gets cut in half. I don't think it's following the halving cycle as closely yet, but we'll find out. Actually, the next 3 months will determine if it's true or not. But look, if Bitcoin at 100,000, it's still early days. Keep in mind the following. 95% of all, and I heard this stat yesterday from Bitwise, and it's very accurate. 95% of all the Bitcoin has been mined. There's only 5% left in the supply. That's very scarce. Like gold is still unlimited in its supply. Yet the US government wants to buy 5%. Institutions this year bought more than 5% of Bitcoin, and they probably want to buy 15%. MicroStrategy wants to buy 5% of Bitcoin. Another sovereign government probably will buy 5%. If you total this up, there's 40% non-retail demand for Bitcoin in the next 2 years for 5% that's available to purchase. That's why I think Bitcoin probably will have the same network value as gold, which would put it at around 1 to 1.5 million per Bitcoin.
Lee estimates that institutional and sovereign demand for Bitcoin over the next 2 years could amount to 40% of the total supply, chasing just 5% of available float. This extreme supply-demand imbalance, he argues, is the foundation for a long-term Saudi price surge. Based on this thesis, Lee believes Bitcoin could eventually reach a market cap on par with gold, translating to a price range of $1 million to $1.5 million per coin. As for portfolio allocation, he suggests a minimum exposure of 2%, with 5% being suitable for most investors and up to 10% for younger individuals with a long-term horizon. Want to know more? Click on this video to dive deeper.